Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Stephen, thanks for taking some time to join me on the show.
Pleasure to be here, Owen.
We're in Sydney recording. Normally you'd be down in Melbourne coming and visiting me at the office, but it's great to be here in Sydney. It's a lovely day. I'm hoping for people that haven't listened to our previous conversations, I feel like we've worked together a lot over the last few years in these discussions. And it's been great to see the Aoris brand grow over time. But for people that are new to the show or new to your brand and what you've created and the way you invest, can you give us the bird's eye view of how you think about investing in business and how that's expressed through the business?
Sure, Owen. So we run a very concentrated long-only portfolio of international businesses. And at the essence, we consider ourselves business owners and we participate in the growth in capital value of great businesses. And for us, great high-quality businesses have a few defining features. Firstly, they've been around a long time, so they're time-tested, which has become particularly important in recent years where a lot of businesses are encountering tough times for the first time. Secondly, they're consistently profitable businesses. They're all-weather businesses, not fair-weather businesses. Thirdly, they're leading businesses. They are number one in their market, and they are leading their industry for definable reasons. Fourthly, they grow. And great businesses don't tread water, and it's hard to become more valuable over time if you don't grow. So great businesses grow, they win more customers, they do more things for existing customers, and they don't only grow with their peers, they grow faster than their peers. If you're in a growing market and you're growing in line with everybody else, that doesn't feel so special. We're looking for businesses that outgrow their peer group. And by owning only 15 businesses like this, it allows us to set our quality criteria very high. And we can be very demanding across all of those quality features and valuation. The price you pay, of course, matters a great deal to your final outcome as investors.
In the past, we've spoken about companies like Jack Henry, we spoke about Accenture and many different businesses like this. And we're going to bring one more to this discussion today, which is really interesting. A lot of people can relate to this business. But there is also the owner's manual, which I'll direct people to on the website, the new Aoris website, which looks great, by the way. The owner's manual sets down all of these criteria and how you think about things like portfolio construction, not just why you invest, where you invest, but how you invest, which is really illuminating. The thing that catches people off guard, though, Stephen, is that you've been doing this for a very long time. We spoke just off air that if you included the track record where you previously were, you'd be in the top 1% of investors, which is incredible. But what catches people off guard is that you do have that portfolio of 15 companies, and yet people are so wired to think that, only 15 companies, this must be high risk. Can you maybe talk about that in the context of what we've seen recently with volatility, the market, inflation, interest rates, etc.?
Well, firstly, thank you for the reference to our owner's manual. We always think it's important if we were sitting in your shoes or the shoes of a prospective investor, they would like to know how we invest, how we think, how we defined ourselves as a business, how we think about success. And so that's all in our owner's manual. Look, in terms of concentration, one side of the coin, the two-sided coin, if you like, is all the things that you won't see in our portfolio. And once you think about those two sides of the coin, I think it starts to make a lot of sense why our portfolio, at least as we think about it, is low risk. And over the last few years, I think that's been borne out. We don't own businesses with a lot of debt. We don't own businesses in emerging markets where the government can play a big role in the way industries operate, which we've seen in recent years in Russia particularly. We don't own businesses that are competitively weak, that go backwards in difficult periods like we've seen in the last few years. We don't own businesses that are aggressive acquirers, where big M&A often causes companies to trip up. We don't own businesses that are very narrow. They do one thing in one place. Biotechnology businesses being a good example. They're inherently fragile businesses. We don't own businesses that make a lot of money in good years and give it all back in bad years, these cyclical fair weather businesses. So for those reasons, our portfolio has stayed away from the many pockets of the market through 2022 and the couple of prior years where challenging periods have caused severe losses for certain types of businesses, a lot of those businesses that we just mentioned. And as we look into next year, higher interest rates start to matter a lot more, and staying away from businesses with a lot of debt, I think, will help keep our portfolio away from those stressed parts of the market. So how for us, it's a very conservative way of investing. As you layer on all those exacting quality features and price. If you pay too much for a good business, you'll end up with a poor outcome. And so concentration, as we execute it in our approach, we like to think is a very low risk way to invest.
Can you talk to us about, or share with us, your views on how companies grow? Because I was reading in the owner's manual just this morning again about the idea of how you think about growth. And that's still quite unique. A lot of investors think that growth is very strong, double-digit top-line growth is very exciting. Can you talk about, you mentioned the capital of the business, the business sustainably growing. Can you talk about how you think about that?
Well, that's so important. I think this is where compounding becomes very powerful. So a few parts of that. One is the durability of growth. There are a lot of businesses that grow rapidly. It's a bit like a sprinter, and then you run out of gas, and the growth doesn't last nearly as fast as long as people think. Number one. Number two, when businesses grow fast, sometimes they cause themselves problems. If they're growing at 20%, you've got to hire a lot of people. The systems just aren't built oftentimes for accommodating growth at that rate. So sustainability, durability, the risk around growth. So for us, the sweet spot's generally businesses growing on a pre-acquisition rate, typically between 5 and 10%.
Right.
If you're growing, we call it GDP plus growth. If you're growing less than 4%, you're not really, the capital value of the business is not growing at a rate that we seek in order to generate an attractive outcome for investors. So the growth has got two elements. One is the natural rate of growth the business is achieving without acquisitions, and that's doing more business for existing customers, winning more customers, and doing it at high rates of profitability. And then once you've done that, then the business has got excess capital. Some of it's typically returned to investors as dividends. Some of it might be used to repurchase shares, and some of it might make acquisitions. So it's the return that business generates on making acquisitions and the share repurchases that is the second of the twin variables about its EPS growth over time. If the business pays high multiples and earns a poor return on its acquisitions, that will undermine growth. If they pay a silly price when they're buying back their own shares, that will undermine growth. So if they grow organically at high rates of return on capital, and they reinvest the excess capital at high rates of return, then you've got a very attractive proposition. And if that's done at rates it's between 5 and 10%, as most businesses across the Aoris portfolio will find, and we believe that can be compounded at very attractive rates for investors.
So we're going to do two of these discussions, and they're going to be split up, Stephen. But I'm hoping, I asked you if you could bring two companies to the table, so one in each episode. And given this is the first episode, I think this is fitting that we might talk about a company that people know quite well, which is Costco. We know it here in Australia because there are these supermarkets around, these big box supermarkets around, particularly the capital cities. So maybe if you can start off, Stephen, by just telling us a little bit about the business and imagine what you feel like when you walk through the door.
Sure. Well, for some Australians who would have been through a Costco, and many perhaps who haven't, when you walk through the door, it's a very different experience than going into a Coles or Woolworths. Firstly, Costco sells a very wide variety of products. So you'll see flat screen televisions. Costco is the largest seller in the United States of fine wine, of jewelry, clothing. So in addition to your groceries and your non-perishables, there's outdoor furniture and barbecues. They're also America's largest travel agent. They have a large food court. So it's a very wide variety of products on offer. It's a very large space. Part of what people love about it, and some customers find frustrating, is the sense of discovery. There are no signs in the aisles, and so people have got to take their huge trolleys up and down these huge aisles and inevitably they find some things that they never thought that they needed, and they certainly didn't come into the store looking to buy, and they stack up their trolleys with lots of things. So they end up walking out the store with a lot more, spending a lot more money, but getting some great bargains along the way. And what's in the store changes frequently. So people know that if I don't buy it today, perhaps it won't be here next time I come. And it's a good reason to come next time because there'll be some unexpected bargains. So all of those make it, for lots of Costco members, a very, very stimulating, exciting shopping experience with lots of unexpected bargains.
I know the feeling when you walk in, and at least my experience has been the first experience is the flat screen TVs, the nice items as you walk in, and then you've got to push past them to get through to the groceries and the other types of things that you're looking for. And it's that experience of wow when you first walk through the door. I find that fascinating.
Yeah, that's right. There will be some popular items at the front, and then maybe there's also a sense of it's overwhelming because it's so big.
Yeah.
So which is why people don't shop there every week, but they might go there once a month or once a quarter, and typically spend a lot more on these infrequent purchases and get some great bargains along the way.
Can you talk us through, I guess, the business, how it fits in with a lot of the criteria? Maybe we'll just discuss this and I'll come back with a few questions.
So let's talk about Costco, and it embodies a lot of the features we just talked about in terms of growth. It's proven to be very durable, and they've grown at an attractive rate since the business was founded in the early 1980s. So there's a few unusual things about Costco as a place to shop. Firstly, you have to be a paying member, in order for the right to shop there. And members will typically pay $60 or I think in Australia, $100 Australian dollars per year for the right to shop in Costco. And there's about 110 million paying members of Costco worldwide. But once you walk through the door with your membership, then you expect high quality items on the shelf at good value. And it's a very resonant proposition in the environment that we're in at the moment when people are looking for value. And it's proven to be a very resonant proposition through other times as well. So in the United States, Costco is the second largest retailer after Walmart, and it's a business where size and scale is enormously advantageous. They buy a lot of stuff, and it's allowed them to manage difficult supply chains the last couple of years more effectively than their peers. It's allowed them to manage inflation more effectively than their peers. And they grow their number of stores in the US a couple of % per year, and then right now there's about 585 stores. It's a business that's highly, highly unusual in that it's been able to take a successful retail concept from one country to another. And that infrequently happens. We've seen with the likes of Bunnings, oftentimes a successful retailer goes overseas and thinks, well, I can replicate in another country what's worked for me in this country. And oftentimes the cultural differences, the competition, the regulation, the consumer preferences are different enough that exporting a retail concept doesn't work. But Costco's done it well in many, many countries. As you mentioned, they've got successful warehouse stores right across in every state in Australia, in very different places like South Korea, in China, in France, Spain, the UK, in Mexico, and Japan, where consumer preferences are vastly different. The size of the cars that people drive around when they've shopped in a store is very different. But it's worked well everywhere, and it really comes back to providing high quality products at value prices.
Do you think that online is a threat to Costco?
It hasn't proven to be. About 10% of the sales are online, and they've probably been late to embrace online, but they're getting increasingly good at it. A lot of what Costco sells is inherently large items, which the transportation costs don't lend themselves well to doing effectively online, but more and more. In fact, Costco, a couple of years ago, purchased its own what they call last mile distribution network in the United States so that they can take control of getting big and bulky items like outdoor furniture and barbecues from the warehouse to customers' homes, and oftentimes having the people to then install unbox televisions and install them in customers' homes, which people appreciate. I should mention one of the magics of the Costco formula is, much like Aoris, is its simplicity. They have only 3,800 items on the shelf. Now, you contrast that with a Walmart, which has about 110,000 different items. You can see vastly different complexity. So it allows Costco to channel its vast buying power across many, many fewer items. And it's much simpler to manage procuring and distributing and stocking fewer items. So the model is inherently much more effective and much more efficient, and it's allowed them to operate very profitably, even though the markup or the gross margin that they charge on these items is much lower than what their competitors charge.
Obviously, one of the things that is really important for these businesses, you talked about acquisitions before in the lead up to this about how they can trip over themselves. When it comes to a company like Costco, can you talk about how you think about the growth of the business and how management have executed?
Well, I think what's helped make Costco a very durable growth story is how thoughtful and patient it is, and that it's been almost exclusively done what they call organically, without acquisition. Now, they did purchase a distribution business, but when they open stores, they don't buy other retailers and rebrand them Costco. They do it themselves, which allows them to be very thoughtful about real estate locations, very thoughtful about hiring managers to run the stores and preserve what is a very, very defined and special culture. When they're entering new countries, perhaps like Australia some years ago, very thoughtful about, will our model work here? How do we have to structure a proposition to make it work well? So it's proven to be durable because it's patient and thoughtful, and they have never entered a country where they subsequently had to pack up and go home because it didn't work. So the success rate of their growth has been very high.
We spoke previously about a business called Tractor Supply, which is a fascinating business, and I'll put a link in the show notes for people to go back and listen and watch that one. But I'm curious, when you do your research into a business like Costco, how do you work with analysts, and how do your analysts go about actually researching it? As far as I know, the team are generalists, but I'm just curious, how do you find an idea? I mean, this one might be hiding in plain sight, but how do you find it?
Well, sometimes quantitative financial screens can be helpful. Other times, just observation, as you said, and other times just wide reading. But I think also the proof points, what we're looking for is the proof points through time. Has the business been able to grow successfully through a variety of different economic and competitive conditions? What do we know about in a competitive environment like retail, how differentiated their proposition is? Now, a few of the proof points we'd find in Costco are across a widely recognised annual survey of retail customer satisfaction in the United States. Costco ranks first, Amazon ranks second, and Walmart ranks 13th. So that's pretty powerful, and it's been very consistently right at the top of the tree. Secondly, the people in the stores, obviously very important to the customer experience. The retention rate of Costco's store employees is significantly higher than a peer average. Once people have been there for a year, the annual attrition rate's less than 10%, which is half an industry average. So the culture, how they manage their people is differentiated, which means that this it's a much more, you have fewer people who haven't been at the store for very long. It's more efficient. You get a superior customer experience because people have been in the store for longer. Because the business is growing, it creates career opportunities. Part of the culture is that they don't hire laterally, they only promote from within. So any person in the business knows that right up to the CEO, everybody started in my role, which is on the warehouse floor, and every opportunity in front of it, every position ahead of me is an opportunity for me. If I do well, I can progress. So it encourages people to stay, work hard, and benefit from a promote from within culture.
That's really interesting. I didn't know that about the team members. And everyone there is really helpful, kind of like the Bunnings experience here in Australia, where everyone's just so helpful and they seem to know everything about everything. But there's also retention. I know that you think about this a lot. The retention rates for memberships as well is also a key thing for Costco, and that membership is crucial. I think it's more like a psychological thing as well, because you buy a ticket, to the fete and you have to go, right? How do you think about that membership in the context of the business as well?
When we think about business quality, we look for a high retention rate of happy customers. And so as I just mentioned, the customer satisfaction rate for Costco members is best in the industry, as is the retention rate. So 92% of their members each year renew their membership. And as the most recent quoted figure, it's never been higher. And so through the pandemic, people have got happier and they've stayed Costco members for longer. there are more members. There are 6% more members, 6 million more members today than there were 12 months ago. And so Costco is doing more business with happier, stickier members. Those are the ingredients for a successful growing business.
How do you go about valuing a business like Costco? We've spoken in the past. I think one of the quotes that you had in the past, which was fantastic, Stephen, was sometimes a discounted cash flow analysis. It's like the Hubble telescope. 1 minute you can be looking at a completely different galaxy if you change one input. How do you think about the valuation of a business like Costco?
I think really the three key variables are how much faster than an average business is it growing? Mm-hmm. How longer will that excess growth persist for? And thirdly, how risky is it? And across all those dimensions, we think Costco ranks very highly. The excess growth is not dramatic, but we think it's very durable. We think we can project out many, many years and it'll still be growing faster at higher rates of profitability than an average business. Mm-hmm. And we think the risk around that is very low. The business risk, the balance sheet, it owns almost all of its own stores, which is unusual for a retailer, and it has billions of dollars of cash on the balance sheet. And when we think about management risk, where it's a management team that's unlikely to steer the business off course by being suddenly impatient and doing a big acquisition. It's all in the features that constitute risk for us. We think Costco ranks the very low end of the spectrum, and for those reasons, it warrants a high multiple relative to its earnings today.
That's a great answer. So one of the things, Stephen, that I've seen proliferate our industry is more fund managers like yourself coming direct to the retail investors. I don't like to use that word, but retail investors, but to direct to investors and saying how you can invest with us. It's simple. And one of the steps that you've taken is to make the fund available, or the fund available via the ASX. So can you talk through why you did that and how it came together?
Sure. So we're anticipating that in February, 2 of our share classes of our international fund unit trust will be available to invest in directly through the ASX. And the reason that we want to do that is to make our strategy easy to invest in for more investors. Mm-hmm. What we don't want to do is create additional strategies. We're a single strategy fund manager, but we like our strategy to be broadly available. So we have our unit trust, which is on lots of investment platforms, but we also know that not every investor likes to invest that way, and making it available to purchase units in through the ASX is an attractive entry point for lots of investors. It's simple. It's one click, and that it's then they will benefit from an established unit trust that's now become much easier to invest in. Yeah,
I got to admit that having the ability just to invest in a fund like yours directly inside my brokerage account is so much easier. Obviously, the wealth side of the industry has the platforms as you speak of, but even I think there's a slow transition amongst some of those groups back to the ASX and to very simple, straightforward brokerage accounts where you can get in and out pretty quickly if you want to. So I'll put a link in the show notes once again to all of that, because I know how these things are not easy to do, and you've pulled it off, which is fantastic. But the final question that I have for this episode, and we'll be back with another one talking about another company which is equally as interesting, which is, why do you think it's important to focus on business fundamentals over forecasts? So what I mean by that is, a lot of what we read, a lot of what we hear and see, maybe even on this podcast channel, is people prognosticating about the future. There's a view, and I think this is going to happen in the next 1, 2, 3, 4, 5 years. How do you think about that in contrast to the fundamentals of business?
Well, I think you're absolutely right, Owen, and the front pages or the business pages of the paper encourage us to think short term. They encourage us to think as investors about macroeconomic variables. And the way that we think about that is that forecasting the future is inherently a low probability outcome. We're just not. There are lots of stats to tell you that forecasting all the variables that people focus on, whether it's inflation, monetary policy, economic growth, political outcomes, it's very difficult to do well repeatedly. But it's also, for most businesses, or certainly the businesses that we seek to invest in, a lot less important to their long-term outcomes than the front pages of the paper would encourage you to think. So the businesses like Costco that we just talked about, whether interest rates are a bit higher or a bit lower, won't matter a bit about its long-term outcomes. Who's in the White House, whether the economy is growing or shrinking, or inflation's a bit higher or a bit lower, that won't be what determines the long-term success of the business. It'll be the quality of the franchise, its management, its ability to put high-quality products on the shelf at attractive prices for its members is what will ultimately matter, whether that's a successful business and it's a successful investment. So that's I think does take a bit of mental discipline to steer away from the headlines and to remember that we own businesses, we don't own economic variables, and we own businesses, we own the long-term outcomes of the businesses, not the short-term outcomes, and those economic variables will matter very little to the long-term success of good businesses.
Fantastic. Great way to wrap it up, mate. I do appreciate you coming on the show again, Stephen, being generous with your time and some of your wisdom today. We'll be back with another episode. Once again, appreciate it.
Thank you, Owen.